Andrew, interesting thinking about the various geographies here and European stocks versus US stocks, or at least non-US versus US. I keep hearing this theme that lots of people talk about, buying into maybe not US stocks right now, buying into European stocks, or following the vaccine over to Asia and buying Japanese stocks. But I look at the underperformance of European stocks, and yes, it's there in the charts, but not as extremely as you would imagine. This is European stocks versus what's happened in the United States on the S&P. So what is your sort of geographical spread for equities at this point?
Yeah, I think so. And it has been sort of an unusual quarter, a lot of it because of the interest rate moves. But I still think rotation is very much the right theme. And the rotation from pandemic losers becoming reopening winners, rotation from the US to non-US, rotation from growth stocks towards more cyclical value stocks. And I think in terms of regions like Europe is hard to ignore right now because we are seeing it start to catch up in terms of economic performance. And we do know that, one of the big sectors in Europe is financials, of course. And one of the areas where we could still see some outperformance being driven by European stocks is through better performance of financials as credit growth starts to pick up and as interest margins start to improve a little bit. So I think the rotation trade is still there, and I think that's probably what we're likely to see through the second half of the year.
I mentioned Japan because a number of guests have talked about buying Japanese stocks as they see the rollout of the vaccine taking shape there. Is that something you can apply to other parts of Asia? Is it something you apply broadly to emerging markets as vaccines become more available in emerging market economies? Is that something that then boosts returns in those economies?
It's an interesting thing. EM has been one of the more challenging areas during this because it hasn't done what it normally does, and EM's normally a strong performer during the early stages of the recovery. And I think vaccines are part of that story, but there's two other things that are going on at the same time. One is the credit slowdown that's happening in China right now, which has certainly been a drag on broader EM as well. And the other has been what we've seen over the past quarter, which has been a little bit of US dollar strength. And I think to see EM really start to have another run, we need to see those three things start to reverse. I think it's reasonable to expect that Chinese credit growth will start to stabilise by the end of this year, particularly as we start heading into next year's very important National People's Congress. Yeah. The rollout is certainly picking up, and I think on balance it's reasonable to expect that we should get some dollar strength heading into the remainder of the year.
And Andrew, just briefly, thinking about credit, are you concerned about US high yield or even investment grade because of low spreads? Do you think markets are taking into account credit risks sufficiently if rates go higher?
Yeah, I'm not particularly concerned about the riskiness of those asset class. I just don't find them particularly attractive right now from a valuation perspective because, as you point out, the spreads are so low. So in terms of seeing that there's some accident out there, default rates are well contained. Corporate profit growth is very good. That's not going to happen. The main issue with those asset classes is the amount of duration that you hold in them right now and that they may be relatively poor performers. But in terms of seeing them as particularly, I'm not sure that's the case.